Financial advisor fees. How much does it cost to hire a financial advisor, to work with a financial advisor? That's what we're going to talk in today's video, y'all. What's going on? I'm Kay Scholl. Welcome to another financial awareness video. So, today we're talking financial advisor fees, and I've been making several videos recently about financial advisors, and in those videos, I've asked you to ask your financial advisor, how do you get paid? And in this video, we're actually going to give you some very specific examples of probably what you could expect as an answer to that question. So we're going to give you a few different things here. I'm going to divide the video up into kind of two halves here. The reaction to the nerdwallet.com article, which I'll link down below. And then I'm going to give you my own personal example of a rollover for a 30-year-old. So if you want to see what that might look like, stay till the end, right? All right. So here we go. Here's the NerdWallet article. So in this, here we go. Assets under management. Excuse me. If you're going to hire a robo advisor, 0.25% to 0.5%, I'd say that's pretty accurate with what I've seen out there in the marketplace currently right now. So that would be what you would pay every single year, and then that fee probably would get broken down into 4 equal quarterly payments, right? So that's how that would work. That would be 0.25 or 0.5% every single year, and that would be in addition to whatever operating expense ratio fees are for the positions that you're holding within your account, within your fund, all right? Number 2, assets under management for an in-person financial advisor. This would be a little bit more along the lines of what I used to do. I had several accounts that were like this, and that would be a 1% asset under management fee. Same thing as the robo-advisor. That fee is broken down into 4 quarterly payments, and that's when the financial advisor gets paid. So you're gonna wanna look at this on your statement. Probably didn't show up on every monthly statement if you're getting statements monthly, probably quarterly. It'll show up on your quarterly statement. Just do the math and do the division and figure out what your financial advisor's fee is. You could find it there on your quarterly statement. Next one, number 3, a flat annual fee of $2,000 to $7,500. I gotta tell you, I was a little bit surprised to see this as an annual fee. That kind of surprised me. I've been out of the game for 3 years now, and I guess I wasn't really paying attention, but I guess financial advisors are charging an annual fee in addition to the assets under management fee. I'm not sure. Maybe some folks don't charge an asset under management fee, and they only are gonna charge you a flat annual fee. So when you're considering your rollover, or when you're considering working with a financial advisor, you just gotta sit down at home on your own time and do the math and ask yourself, okay, if I choose this person, if I choose that person, if I decide to go this route, what will it cost me? I think that's the purpose of this video, is to give you a little bit of a nudge to sit down and take the time to do that. Next one, an hourly fee of $200 to $400 per hour. What I like about this is it's on your own time, and you can be very specific with what you want to accomplish in that 1 hour or in that 2 hour, whatever it is that you hire a financial advisor. I would also say if your life is not terribly volatile and year by year it's fairly similar, and you're not a serial entrepreneur that's going all kinds of crazy different directions, you might work out just fine hiring a financial advisor for just an hourly fee, because your life might not change frequently enough to where you really need that level of annual detail, right? Next one, number 5, per plan fee of $1,000 to $3,000. This, to me, is right in line with what I was expecting as well. I think for a personal retail investor, that's accurate. I think a business plan, you're gonna see at least probably triple that. I've even years ago, I heard that someone doing a business evaluation or a business financial plan, more like $10,000. So really just depends. All right, so there you go. So that was the NerdWallet article. I'm now gonna pivot over into maybe a couple different hypothetical, 2 or 3 hypothetical examples in the event you were to consider working with a financial advisor. I'm gonna give you a few different options of what that might actually look like in terms of real cost, okay? So here we go. According to this news article that I put up here in a minute, right? I forget it'll be sourced down below. I'll put it down below. But according to the average 401k balance for a 30-year-old right now, it's $30,000. So we're gonna see a bunch of 30s here real quick. A 30-year-old individual that has a $30,000 rollover that has a time duration, time holding, time period of 30 years until they turn 60. So 30, 30, 30, right? Very easy to remember. What does that look like if you were to hire a financial advisor for a 1% annual fee? Well, let's look at that. Well, if you don't hire a financial advisor and you just do this hypothetically speaking on your own, and you get on average an 8% annual return over that 30-year period, that $30,000 rollover would turn into $271,879. Compare that to if you were to, hypothetically speaking, pay 1%. Now, again, this is a linear graph. Not the real graph is up and down like this, but this is a linear example just for the sake of this example and this YouTube video, right? If you were to pay a 1% fee, then you're not getting an 8% return. You're getting 8% minus that 1% fee, so you're only getting a 7% rate of return, which would be $198,367, a difference of $73,512. Just because when you were 30 years old, you didn't take the time to do a little bit of Googling and researching and YouTubing some videos. So, to me, I think that's a little bit excessive. I'm starting to kind of take this opinion in many of my videos of a distaste for qualified retirement accounts, especially ones that have a duration holding period of more than 10 years of having this annual fee every year. So I kind of take a little, I don't know, you get what you pay for. Maybe the financial advisor is worth it. Maybe they are. But if you're already committing to this account, you're going to lock it up for that long, I don't know, maybe you might be better doing something else on your own. So that's going to be the next example. Well, I'm sorry, not on your own. Example 2 would be, what if you didn't hire a financial advisor for a 1% annual fee, but instead you did something a little bit different? I didn't cover this before, so it's a little bit different. I'm going to call this the Dave Ramsey method, because he loves to talk about this one fund that gets 13% and what if he's half wrong, right? I'm summarizing and paraphrasing here, but at the end of the day, I've done a little bit of research on his remarks, and based on my understanding, I think he's talking about Capital Group. And underneath Capital Group, you've got American funds, and underneath the portfolio offerings of American funds, you've got the growth fund of America, I believe, right? So you can Google that and look it up for yourself. That's kind of where my research leads me to believe. And so that's what he's referring to. And so if you were to go that route, the first thing I'll tell you is I'm going to teach you about breakpoints real quick. If you take all $30,000 and you give it all to one fund family, like Fidelity, like American funds in this example, then you typically are going to hit what's called a breakpoint. Now, Fidelity, their first breakpoint starts at $50,000. Fact check that. It's been a few years since I've been in this game, so I'm not sure that's 100% accurate today, but years ago, that's what their breakpoint was. What does that mean? That means if you buy a Class A share mutual fund from American Funds or from Fidelity in this example, you will get a breakpoint of a reduced one-time sales charge if you have more than $50,000. Well, in this example, you don't have that. So if you were to take this $30,000 rollover all to Fidelity, you're going to pay a 5.75% one-time sales charge. However, conversely, in this example today, I'm talking about American funds, and American funds, they have a breakpoint at $25,000, and that takes your one-time fee from 5.75% down to 5%. Yeah, it's still a one-time fee, but it's a little bit less, right? So as you're working with your financial advisor, these are some very specific questions that you're going to want to ask so that you feel a little bit more involved. As an example, a 5% one-time sales charge for buying a Class A share mutual fund with American funds would be $1,500. Compared to $73,000, that's quite the difference, because this $28,500 that now is going to grow, arguably, let's just say it's going to grow at the same operating expense ratio as the 1% fee from a moment ago, right? The same. Anyway, so, fees matter. Fees matter. Option 3, I'm sorry for rambling. Option 3, I'm going to call this option if you're willing, right? This is the if you're willing option because it requires you, and I'm going to talk to the retail investment trader, the retail investment investor, if you will take some personal responsibility and you will try to do some research and do your own due diligence and take control over this $30,000 hypothetical rollover on your own, then you could do something that a lot of people do, which is just, ETF and chill, dividend and chill, ETF and chill. You could buy an S&P 500 index or another index fund, and you could just let the money sit. I will tell you, from a risk tolerance perspective, only buying the S&P 500, that's fine with me because of my risk tolerance, but you have to see if that works for you and your risk tolerance, because we're not all created equal. Some people get really uncomfortable during market volatility. If you don't have the patience to weather the financial volatility of owning the entire S&P 500 as it goes up and down, then you need to take that into consideration when you take personal responsibility and you make this decision on your own. But this video is about fees, you guys, fees. And if you were to take the reins in your own hands and do this yourself and buy a low-cost ETF index fund, you're not going to pay any sales charge. You're not going to pay any 1% annual fee, and the operating expense ratio will be so low, it'll be fantastic. So we're going to call this the personal responsibility if you're willing to do this on your own, right? Hey, listen, sorry to go on all those long rants. I really do appreciate your time. I hope this video was valuable to you. If so, please leave a like or a comment down below. I appreciate your time. I will see you tomorrow.